My name is Anthony Fatsis, and welcome to the WTFinance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again. I hope you enjoy.
Yep.
Awesome. So hello, everyone, and welcome to Warwick Trading Society third guest speaker event with Ivan Ripamonti, blockchain and crypto investment manager at Iconic Holdings. So the event is in collaboration with Warwick Crypto Society, King's College London Economics and Finance Society, Leeds University Union Trading and Investment Society, Lancaster University Investment and Finance Society, and WTFinance podcast. So a bit of a mouthful, quite a few people involved. The event will include a short interview with between myself and Ivan, and it's going to be Q&A, so it's open to anyone. If you have any questions, we're going to keep it muted just to maybe make it a little bit more manageable, but just put it in the chat and I'll ask them directly, and we can go from there. And Ivan said anything's open, anything to do with crypto and blockchain. If you can't answer it, he will say, but ask it, and you never know. And it will also be recorded today. It will be uploaded later on to the WTFinance YouTube and podcast channels in the coming days. So I'll share that with all the societies, so no stress there. But so first of all, Ivan, thank you so much for joining us. And just my first question, can you talk about your career so far, and maybe what attracted you to blockchain and crypto?
Yeah, great. Thank you very much, Anthony, for the invite. Pleasure to be interviewed by you. But I started, let's say, back in 2017, end of 2017, my adventure in crypto and blockchain. So I was working for a security testing company, and they were kind of interested in servicing this new emerging segment, in particular towards the end of the bull run in 2017. But I, let's say, more concretely moved into blockchain in 2018. Where I joined a blockchain venture studio that was focusing on advising enterprises. We were advising Novartis, Enovos, and few, let's say, large corporates in the DACH market, mainly Germany and Switzerland. I joined them with the ambition of setting up within this venture studio a crypto hedge fund. We kind of faced a lot of challenges as, let's say, in 2018, the regulatory framework to create a fund for professional investors that wanted to invest in crypto was not super clear. There was some countries such as Malta that kind of moved ahead to regulate crypto assets and create kind of fund vehicles or investment structure that could invest in crypto assets. But there was a very limited range of options in terms of regulatory setup to structure crypto funds, but also in terms of service providers, as very few service providers were kind of ready to service a crypto hedge fund. So we started the process in Malta towards May 2018, and we received our license in 1 year later by the MFSA towards May and April 2019. So we launched a kind of crypto hybrid hedge fund where I was involved as of head of research. So I really spent most of my time in 2018 and 2019 researching on blockchain application, of course supported by a quite a large team of data analysts, financial analysts, and kind of tech expert and developers. So we were around 10 people researching for that fund. And finally, in June 2019, we launched the fund. Actually, May 2019, we launched the fund, and now it's still active as called Kintaro Capital. Shortly thereafter, I kind of received a very interesting proposal from Iconic. So I moved to Iconic to kind of start their asset management practice. Iconic it's started in 2017 on the venture side of the business, but in 2019 we were approached by Christian Angermeyer, Mike Novogratz, and Alan Howard that invested on the holding of Iconic, and they wanted more an exposure to the asset management side of the business, as they were already active in ventures through their Maltese-based vehicle. And we kind of started again from Malta, as it was the one of the few jurisdictions that was open to regulate crypto assets funds for professional investor. And then from there, we received a license from the MFSA. We issued the first fund in January 2020, so that is a top 20 index fund. More recently, we issued a second fund in Malta. It's a top 10 short-term momentum index fund. And in 2019, since we are a Frankfurt-based asset managers, we got to know from, let's say, from the exchange, Deutsche Börse, etc., that there was the opportunity also of listing crypto ETPs. So we also set up an ETP practice later on, so that we could have not only investment vehicles that give you an exposure to crypto asset for professional investor, but also products that could be accessible to retail in a kind of known format, such as the ETP structure, accessible through a regulated market, such as etc. So took quite some time for us, kind of moving from asset management VC side to index funds, and later on to ETPs. But in April this year, we got approval by BaFin for the issuance of Bitcoin ETP. It's not an ETF, as unfortunately kind of the ETF wrapper it's not possible in Europe. But we listed this Bitcoin ETP on Xetra, on Euronext Paris, Amsterdam, and 626 Exchange. And now we are focused really on scaling the ETP platform, and we'll be bringing to market more ETPs through a new formed Liechtenstein-based issuer. And we also in parallel are working to bring to market some Cayman hedge fund next year. But just to say something about our pipeline for next year. So that's in a nutshell what Iconic is doing. And then at Iconic, I'm taking multiple roles, as we're a small shop, about 15 people. So I'm acting as portfolio manager. And at the same time, I take care of operation related to this fund, such as the Maltese funds and the ETPs. So happy to answer any question you have, Anthony. I've already made a very long introduction.
Yeah, no, it was really interesting. And you said you got into it in 2017. Were you attracted by the money or the technology? Now be honest.
I was definitely attracted by the money. I invested a little bit. To be honest, the first asset that I discovered was not Bitcoin, but Ethereum. I listened to a documentary on Italian national television around June on Ethereum, the idea of creating a supercomputer that is decentralized, and kind of the idea also of building multiple applications on top of this supercomputer was super attractive to me. Later on, I discovered Bitcoin, but at the beginning, I really living in Berlin, where there was a very large development community. I believe in 2017, 94% of the developers were in Berlin, were Ethereum developers. I started kind of dive deeper from Ethereum and the idea of building kind of industrial application into blockchain. But let's say later on, I moved more to the investment side and discovered kind of the importance of store of values, and then say the monetary value of Bitcoin, and why it's such as interesting and superior store of value for a number of features that of blockchain and of the Bitcoin blockchain.
Yeah, definitely. I'm guessing. So you're the investment manager. You're focusing on, you're making sure that all the investments are, are obviously going to be profitable, hopefully in the long term. When you're analyzing these assets or these, companies, I guess, or these cryptos, what are you looking for? I know you can't obviously divulge your whole strategy, but what are the main things that you look for when you're looking at these, these different cryptos?
Yeah, I think let's say the valuation. It's a big topic in crypto because, of course, it's like investing in equities in the 60s and the 70s, where kind of the free cash flow models and then the different multiples that are applied to equity were not yet established. Like McKinsey didn't come out with a book about free cash flow, and unfortunately McKinsey didn't yet cover, let's say, valuation for crypto asset. So there's not a standard. So whatever valuation methods we use and we analyze, it's not set in stone. Also because there's not a standard within the market, so not all the market participants agree on let's say the way assets are valued, and if they agree on a specific methodology. For instance, they agree that Metcalfe is the best way to value crypto asset, Metcalfe being quite popular way to value highly liquid crypto assets. They disagree on how to come out with a Metcalfe calculation. So like, while if you analyze equities, you look at the free cash flow for a specific company, you go to Bloomberg and you download it already done. So this you can, of course, analysts make adjustment, control, but there is, let's say, a framework and certain standards that is lacking in crypto. If you go to Bloomberg, you find amazing research on crypto assets, but you can't download evaluation methods set in stone that everyone will accept and understand in the market. So I believe there's a big difference whether you're analyzing investment in equity of blockchain companies or you're analyzing tokens. I guess the two are competing because it's usually, let's say, the token is taking away a bit of the equity value of the asset. That's why I believe the first investor that came into the space were mainly venture capitals, that they realized that if they were not investing in tokens, they would have missed out on a number of deals, and that tokens were competitive to their business, as a lot of startups in 2017 and 2018 preferred to go through the token fundraise versus an equity fundraise. But even though they are competitive and probably they're sourcing towards the same source of value, they are analyzed and work in a completely different manner in certain respect. So while I believe a diligence of an equity company in blockchain, leaving aside the technology aspect, is quite similar to the standard venture capital job. Let's say every kind of diligence we do on a blockchain companies involves kind of background checks on the founders, checks on problem market solutions, if there is a product market fit, assessing the size of the market, assessing the business model. So something that is quite standard in the venture capital space, just applied to a different industry such as blockchain. I think token and investing in token is a complete new practice. Everything is done different in certain respect. So for instance, you have a big topic related to regulation and the regulatory status of a token, and then whether it's compliance or not, or whether it's distributed in the US and properly or not properly, whether it's a security or not, which is a topic that is not really much present with regards to equity or blockchain companies. So you have different aspects that you need to diligence, and also different economics. So that's why I think the term token economics or tokenomics is fitting, because let's say a token creates a different economic environment that needs to be assessed on its own, besides the entity that is issuing this token or promoting a project.
You mentioned something there. It's like trying to do the background checks into these founders and actually try to do due diligence, which I'm sure is very hard. And if you look at maybe the big institutions, they probably have you could say FUD. They think there's FUD behind a lot of things in crypto and blockchain is, maybe, it's not legal. There's all these other issues as well. Have you seen those sort of maybe objections against investing in crypto and blockchain from these institutions? I'm not sure if you deal with that. I know,
Yep.
Iconic do deal with institutions investing.
Yeah, of course, I believe that the first steps for any institutional investor, say the term institution is quite broad, as it touches from professional investors to real institutions such as pension funds and insurance, and each of them, they kind of have a different rule book, and they have different kind of limitation on what kind of asset class they invest and different goals. But let's say the main problem for any professional or institutional investor to enter the space and investing is knowledge. So before entering, there is a huge learning hurdles that I believe a lot of players have been undergoing in 2019 and 2020, and they managed to enter successfully or less successfully the space this year or last year. But a lot of let's say institutional players, perhaps they're not yet ready, so they're sitting on the sidelines and kind of doing the research, which is probably better than just entering the market unprepared and with feeling the FOMO of the market going up. So I think, let's say, from a background perspective and founding perspective, now it's easier, because in 2017 you didn't have many points of reference. So you could have invested in an entrepreneur that have a track record on the internet in building startup in the internet space, but let's say you didn't have any entrepreneur with successful track record in building blockchain companies. While right now you see serial entrepreneurs that launch successfully a project from one chain and they're moving to another chain, or they're building their own chain. And I think the best example, for instance, it's Polkadot, Atom. So all these new chains, Solana, let's say the community behind this chain, it's usually coming from another chain. So I think Polkadot is the best example. Gavin Wood, the founder of Web3, was successful in being part of the early Ethereum community. And then later on, when he moved to a new project, of course, kind of the team that he brought together was already a team with a track record in the space. So definitely now it's a lot easier, but still there's a lot of job to do, in particular with regards to the technology assessment and technology diligence, which entails, for instance, reviewing code that is not written for all the chain on familiar languages, or languages that are familiar to the financial industry. Like, for instance, Ethereum is using Solidity, and Solidity is just used by Ethereum. So if a VC wants to diligence an Ethereum-based project or review the smart contracts of an Ethereum project, they will need to hire someone from the blockchain industry, or someone that has experience with Solidity, and there are very few resources like that, let's say, outside. So
yeah, definitely. I think I've heard somewhere, some of these blockchains have hundreds of thousands of lines of code. So you can imagine, like, for one person or multiple people to do that takes months potentially just to look through. And, it could be one small thing that could potentially be, have a massive effect on the actual stability of the code and, how safe it is.
Yeah, and I think there was a study in 2018 that I believe by PwC, if I'm correct, what I might confuse, that say that 80% of the ICO were not enforcing in the smart contract the clause that were expressed in the white paper. So there was this arbitrage, because the VCs and the investors, they were not ready to understand and diligence the technology aspect and make sure that what was written on paper was actually corresponding to the technological reality. And now this gap has been bridged. And if you don't have an MVP or a working prototype, you will probably not be able to raise funds. And the investors, in particular, I believe smart allocators, they understood they cannot just invest on the basis of a white paper or let's say a classical financial economic analysis. They need to look also at the technology aspect. Yeah, so there is a more interest and more awareness about the fact that at the end of the day we're investing in a technology that is quite complex and that requires kind of sectorial expertise, which is very expensive. It's difficult to source talent in the industry, in particular that is able to review code and understand the technology, but it's needed. to find an edge. I believe some of the smartest allocators in the space, they have an edge, not just from economic and financial standpoint, but also on the technology side and technology understanding.
Yeah, and I guess the challenge is that a lot of people have maybe gotten a little bit lucky, and they've made quite a lot of money. So it's easy, as you said, to FOMO in and just to think how, they made money, then why I should just go in. But as you said, it's taking a step back and learning, actually analyzing a bit more.
Yeah.
Yeah, perfect. So we have a few questions here from some, and they're really good. But I'm just going to ask you one more question. You mentioned there that these institutions are trying to, they're trying to learn themselves and understand more about the technology. So for maybe students here who might not know as much about crypto or are looking to learn, do you have any resources that you've found helpful, or any websites or anywhere else that you'd recommend people go?
Yeah, I believe Cambridge University and Stanford published a number of courses online, whether free or kind of available for small fees. So I also followed the Stanford course on Bitcoin basics in 2017 when I started my journey in blockchain. But I believe right now there's so much resources, whether on YouTube or on Reddit, that let's say I will not know where to start. I would suggest to follow perhaps some academic course, but at the same time, let's say try to follow some podcasts built and run by blockchain natives. Then of course it really depends on where is your interest in the space. If you're looking more from the venture capital perspective, there are podcasts that are better fitting, run by venture capitalists. Or if you're looking more at the technology aspect, I would suggest Epicenter has been quite popular, and you have so many episodes right now online that you can definitely learn a lot, going back also of the discussion in 2016 and earlier. But I think there's a ton of resources right now, like in 2017. So it's a lot easier right now to enter the space, even though I know it's the hurdle is very high. It's not an easy technology. It's not an easy space, so it takes some time to learn.
Yeah, definitely. And I guess I'd add that as well. Don't expect to learn it very quickly. There's so much to learn. It can be quite complex. Don't be in a rush. Just spend your time, a few hours every week or so, and then over time you'll learn and you'll get better at it. But we have some great questions as well. So one of them is from George, and he's talking about stable coins. And I guess there's been a little bit of controversy about stable coins, and are they actually backed by US dollars, and what's happening there. So George is saying, do you think is it sustainable with these stable coins that they can sometimes offer interest rates that are a lot higher than actual central banks? So
Mm-hmm.
do you think that's sustainable? And, maybe do you have a favorite stable coin? I'm not sure if you can say that, but.
Yeah, no, I believe this will be it's already a debated topic, but it will be a very hot topic next year, because regulators, and in particular in the US, they're very much attentive to the topic. I believe, let's say, the yield or the higher interests that you can generate from stablecoin is not coming necessarily from the construct of stablecoins. Stablecoins are just a representation of stable asset. Usually they track, let's say, major currencies. I would say one main currency, US dollar, as more than 90% of the volume on the market is versus US dollar or USD based stable coins. But let's say that they were kind of introduced in the space to solve an issue, that it was the access to fiat. When the market exploded and there was a lot of new entrants, let's say the fiat on ramp and the fiat gateways were very few, unstable, and let's say they were not sufficient to guarantee the liquidity of the market or provide enough liquidity for a market that had so many new entrants and market participants. So I believe the stablecoin topic became prominent in 2017 because let's say there's very few banks that were supporting cryptocurrencies, even less that they were willing to work with crypto exchanges, that they could understand the technology and manage the risk of dealing with crypto. So stablecoins were founded to kind of solve the friction between the fiat system and the crypto system. Later on, like, I believe that the space developed so much and the infrastructure developed so much in DeFi. So let's say we went from building exchanges and just using stablecoin as money or a means of exchange to kind of building a new financial infrastructure as a whole. So the DeFi topic, I believe, became very popular in 2020, but it has been a longer process, like from building decentralized exchanges, so from decentralizing the exchange of coins, but to building like lending protocols, insurance. So right now there's a full financial ecosystem built on chain and running on chain, and that's when the stable coins really became critical, as they are critical currencies such as euro, US dollar in the current kind of financial ecosystem. I would say definitely there is a need for regulating the space because it got very, very big. And some of these stable coins, they create a systemic risk that is not systemic, not just in crypto, to name like Tether or USDC. If they were to have any issue, they would create an issue to every market participant, but they're probably starting to become systemic also outside of crypto. That's why regulators are very attentive to that. And at the same time, they enable a new economy based on decentralized finance that it's working very differently than traditional finance. So it gives you higher yield. It gives you the opportunity of managing freely your money, especially through decentralized protocols. And that's something that is not, let's say, fitting the current regulatory framework and the frameworks that regulators have applied so far in the traditional financial system. So I'm very curious to see how regulators will approach and try to oversee this ecosystem, because it could be a great benefit for the industry, so that you have more transparency and you don't have any more concerns of whether a stable coin is collateralized or not, or whether it's properly managed, risk management is done properly or not. But there could be also drawbacks if the regulation is kind of limiting innovation, which is partially a concern I would have in the US right now. Whether there is an intention of fostering innovation and kind of protect consumers, or there is an intention of fitting the stablecoin system in the traditional banking infrastructure, which is not really fitting, let's say, at the moment. But this is a bigger topic also for the EU, what the EU wants to do with regards to stable coins over the long run. Yeah.
Yeah, it's interesting. And do you see there, like, say, if the US or the EU were to ban stable coins, I'm not sure how they'd do that, but if they were to do that, do you see there's an opportunity that could be like a run on the state, like, it's like a run on the bank, a run on the stable coins where people are just selling their stable coins and they get to the point where there's not enough assets to actually support it, if that makes sense. So then it gets, some people will actually lose out. They won't be able to transfer their stable coin to crypto. Do you see that possibly happening if lots of people are trying to get out?
I personally think the ban is not something that is under consideration. So I am not afraid of a ban risk, or that certain stablecoins will go out of circulation overnight. But there can be restrictive regulation that makes very difficult for certain stablecoins to operate, or create parallel markets. You might create kind of an institutional market and let's say a non-institutional, unregulated market, and make it impossible for the two markets to communicate and interact. And this will create a lot of limitation with regards to innovation. There was a lot of debate with regards to regulating and then enforcing AML/KYC standards on an hosted wallet in the US. And I believe it's important that we say any new regulatory framework will not cut out DeFi and then hosted wallet from let's say more centralized systems, because that definitely will have a big impact on the price of crypto assets as well, but on the possibility of innovating and growing of the industry. Let's say I think any restriction or ban has been quite a successful so far. So, but this can limit and delay the growth of the industry. Let's put it this way. And I believe for the US as another bigger topic, like right now, the market is entirely US oriented. US dollar is the, let's say, traditional finance store of value in crypto. And let's say we need to solve this issue if we want also to decentralize really crypto and not making dependent on the success of few stable coins that are USD based. We don't want to make also crypto dependent and to US based stable coins. We want to have kind of a growing market share also for Euro stable coins, pound stable coins, so that any regulation or any issue that the US might face in the future will not produce negative results towards the entire crypto market. And at the moment, I would say if the US regulator were to enforcing restrictive regulator or punishing existing stable coins, this will have a strong impact in the market. So and the US very limited geopolitical influence in the market, at least from the stable coins side, which is something. It's bad for decentralization, but also it's bad for Europe. That is the smaller players in crypto. It's the least relevant in crypto at the moment.
Yeah, and you could say that China's, they've sort of, crypto's disconnected almost from China. So, you hope it can happen from that in the future, almost disconnect from all economies. But so sorry, I'm going to move on to another question from Amain, which is quite interesting. So they ask sort of, do you hear any concerns from investors about the environmental footprint of proof of work crypto assets like Bitcoin, especially given their ESG? So are they sort of worried about the impact it can have on the environment?
I think that's a big topic, and I'm glad that finally a lot of crypto native companies and miners are starting to discussing and tackling the topic kind of transparently, because I believe the ESG argument has been used for long in a similar way to the money laundering issue argument, a way to kind of deny the existence of the asset class and associate the asset class with negative feelings or criminality. So let's say the ESG topic has been used for long by people, but that they really didn't do much of the research on crypto and to undermine the role of this new asset class. But at the same time, there is definitely a topic with regards to proof of work that is an energy intensive way of validating transactions. And let's say the debate luckily shifted from let's say Bitcoin is bad for the environment and therefore we should stay away from Bitcoin, from saying, let's say, let's try to understand what is the real environmental impact of Bitcoin, what is the environmental impact also of alternative currencies or alternative source values such as gold, but also euro and US dollar, that everyone kind of doesn't consider so relevant the environmental impact of euro US dollar. But it's, let's say, if you compare a means of exchange or if you compare source value, you should kind of compare them on the same criteria and in a similar way. So I think actually the space in the last 3 to 6 months have done a lot in doing research and developing academic papers to try to estimate the carbon impact of different players in the Bitcoin value chain, from miners that produce Bitcoin, and they're the one that actually are responsible for the highest energy consumption in the supply chains, to exchanges that, even though they are not producing Bitcoin and they don't consume as much as energy as the miners, they are still moving around assets on a daily basis. So every transaction, every transfer has certain environmental impact, even if smaller than the minor ones. And we recently as well kind of engaged with Frankfurt Blockchain School to do a research for us and develop a methodology to assess the carbon impact of Bitcoin and the carbon impact of one of our products, say a Bitcoin ETP that is listed on etc. And they proposed two main ways of assessing this carbon impact, whether that being based on the actual consumption for producing the Bitcoin itself, or that being based on the transactional consumption, so how much energy you consume for transferring the asset. And I believe, let's say, we're at a real beginning. There's not yet an academic standard. There's not yet enough data, in particularly related to the mining industry. The mining industry, it's developing, is changing, and let's say there are certain universities such as Cambridge that are trying to map it, but let's say, since the industry is changing so fast, we don't have clear transparency of where the miners are actually located, what kind of grid they are plugged into, what kind of sources of energies they're using. And that's kind of limiting any attempt to actually understand the carbon impact of Bitcoin, or the environmental impact of Bitcoin, or any other proof of work chain. I believe, let's say, there's been a lot of progress, there's been a lot of research. There are methodologies that are robust, such as the one that Frankfurt School developed. But we are missing data. We're missing data on the mining industry to come out with estimates that are, say, accurate by less than, with variation of less than 1% to the reality. And I guess let's say, since there is a higher attention to the ESG topic, let's say all the industry participants should think about that and start contributing to the data side as well, not just thinking about understanding the carbon impact of their product and the environmental impact of Bitcoin and trying to offset that, but they should also start thinking about how we collect the data so that we can come out with accurate estimates on carbon emission of Bitcoin. And that is a very big topic, and that's something that I hope there will be some progress in the future, and people funding such kind of research from reputable university.
Yeah, definitely. And I think, as you said there, sometimes people don't understand how much energy the actual traditional financial system use. Like, it's so energy intensive. So I think that's, as you said, sometimes it's just a way to talk down cryptocurrency, I think. But sorry, we have so many questions, so I'm going to go to my next question with from you, Raj. So at the Boson Protocol conference last week, a lot of industry experts said that DAOs will be massive in 2022. So obviously decentralized, autonomous, or I can't remember what the O is, but could you explain why, or if there will be sort of other trends in 2022?
I personally believe stable coins will be a very hot topic in 2022. Not just because we expect some regulation from the US and from the EU, but also because, let's say, the market is in a very positive trend, and the correction are expected. And certain ecosystems, such as the stablecoin one, is not the only one. They, let's say, have higher attention in when the market comes down. Let's put it this way. So I believe the stablecoin topic became very hot in 2018, and if we believe, say next year we will go through a phase that is comparable to 2018, then the stablecoin topic might come back as well. I believe DAO have been big. It's been a big topic since the very early days. Let's say there is a lot of uncertainty on the regulatory side for DAO, and but at the same time we're coming at a stage where DeFi, but also the NFT ecosystem, they need to be plugged into a DAO environment to really create a full financial ecosystem. So I agree with this claim. That being said, let's say when the market corrects, everyone thinks about stability. So I would say probably if I need to bet on the hotter topic next year, I would say stable coins, and DAO will remain a relevant topic not just for next year but for the years to follow. And I believe that's a topic that the regulator are not even understanding right now. DAO, and it's going to be very difficult to integrate DAO into the traditional financial ecosystem. So that it might take, let's say, adoption might take longer than people think, in my opinion, with regards to DAOs. Adopting Bitcoin and Ethereum is a lot simpler than let's say creating and interacting with a DAO. And the DAOs have a lot of technical risk and failures because the terms DAO has been bounded since the early days with flows and hacks, and people that are coming from the Ethereum ecosystem know it quite well. So it's a revolutionary concept, it's a revolutionary technology, but it's not so easy to implement. I think also zero knowledge proof is an amazing technology, but unfortunately it's a bit away from gaining widespread implementation. So I believe DAOs will take some time to really be developed and adopted on a wide scale.
Yeah, it's interesting. You mentioned there that obviously stable coins will be very, potentially next year they might be quite popular. So do you think there'll be a correction next year in the crypto market? You sort of like implied it there. I'm not sure if you think that.
I think people should, even though we are in the longest bull market in history, I think people, let's say, and even though the bears, they're usually the ones that are least right in history, in any history, not just in the last 100 years, people should not assume that the market go up vertically forever. So it's very hard to predict anything in the crypto market. But the crypto market is not, it's uncorrelated to traditional asset classes. It's quite detached from the dynamics of other traditional markets, but is not living in a bubble. So if there was to be negative macroeconomic trend, that might impact as well the price of crypto asset, and I think it's something natural and healthy if there will be a correction next year. If the market was to continue go up for all year next year as well, I would be actually scared about that. So I'm not saying like 2017 and 2018 will be replicated in the exact same way, so that in January we see a correction coming through. That I think it's too easy to think that this will happen. But I'm saying that next year we should expect the market at least to calm down a bit, and people should plan, because every kind of rotation in your portfolio or change in macro trend is an opportunity. So that's something people should at least consider and have it on their radar.
Yeah, and as you said, it's healthy for the market. If it goes straight up for 2 or 3 years, then there's going to be a much bigger drop. Whereas if we go up and then it comes down a little, that's a lot healthier for the actual market and the long-term prospects.
Yeah. At the same time, I think if we go through a bear market, and I'm not saying most of next year will be a bear market or not, and I don't want to hazard any prediction, doesn't mean it's going to be the same as last one. So I believe for the first time, let's say an asset like Ethereum gained widespread adoption and was adopted also by institutional investors. But at the same time, no, like I've seen a question now coming up, if we rely on technical analysis, the answer is no. So, but at the same time, I don't want to say it's irrelevant. But as Iconic, we do not use any technical analysis. So my consideration are not related to any technical analysis. So let me make a disclaimer. But sorry, I was saying that there is a macro trend that needs to be taken into consideration. So people should kind of consider that there is a macro trend within crypto, and things change. So like in 2017, Bitcoin, Ethereum, and every crypto asset was highly correlated, and they were moving up together because crypto was the new asset class, was the game changer. I think now investors are a little bit more sophisticated, even retail investors. So they understand there is a difference with Bitcoin and Ethereum. And then there are the Ethereum contenders is a big topic. And the development community and the application, they are not built anymore, such as was in 2018, primarily on Ethereum. There is a number of chains that started to be adopted, such as Solana, for instance, but also Binance chains. They are largely adopted. So the space changed, and there is NFT right now in the market, and every of these industry, like the Ethereum industry, the Ethereum contenders industry, the NFT industry, they are not necessarily so highly correlated. So I will not expect a bear market where everything goes down and everything goes up as it was in 2017 and 2018. Because in 2017, there was very little industrial use case, very little application on blockchain, very little adoption. So most of the price appreciation was just driven by hype, which I'm not saying there is no hype right now, but there was no real value driver or economic driver of the price appreciation. And that's when the retracement came, like people were not saying, oh, look, I take profit, or I go to cash just on my Ethereum position. They were going to cash on for the full portfolio, and still cash is the main edge for any crypto portfolio. But people understand there are trends. There is the metaverse trend, there is the NFT trend, and they can still profit in a correction by allocating to certain industries, such as the gaming industry, that they are resilient, or allocating to the stablecoin industry that they are resilient, and they can profit in different market conditions. Like one of the major Ethereum contenders is Terra Luna, which is a protocol that has been adopted mainly for the development of stablecoins or a stablecoin ecosystem. So a protocol such as Terra Luna, I don't see why, in case of a correction of Bitcoin Ethereum, should not appreciate, because in case of a correction, probably there is a rotation of the portfolio from Bitcoin Ethereum to stablecoins, and then Terra Luna, it's an ecosystem and has been built and developed for stablecoins. So that's just to say, if there was to be a correction sometime next year, and probably not in quarter1, doesn't mean there's not going to be a lot of opportunity in the market. I don't expect 2018 to replicate. I think a lot of people say that history doesn't repeat, but it rhymes, and that I think is good way of putting it.
Yeah, I really like that quote. So we're going to keep moving on because we have a few more questions.
Yep.
So we have a question from Yusuf. So he's saying, what are the main challenges in raising capital for cryptocurrency investments? And sort of how do you manage investor expectations and account for volatility? So I guess, are they looking at more as like venture capitalists, like it's a long-term play? How do these investors look at it?
Yeah, no, I think definitely the first wave of investors has been mainly family offices, in particular family offices that they were already exposed to venture capital or venture capitalists themselves. So they are quite risk takers and less sensitive to the volatility. But this year in particular we have seen other type of investor, even more risk averse, more prudent, more institutional focused investor entering the market. And those, of course, they let's say they are not used to the volatility of crypto, and they might be impacted by that over the long run, or be pushed out of the market for some time. So I think, let's say, volatility, of course, it's what makes this market interesting, especially the upside volatility. And it's a feature of this market that while going down, because the volatility of Bitcoin has been historically going down, is a persistent feature. Like the volatility of Bitcoin, it's 3-4 times the volatility of any asset class, still at the size that Bitcoin is. That is, it's almost the size of silver in terms of market capitalization. Still is a lot more volatile than silver, and commodities are volatile by definition as well. So I think definitely volatility makes this industry not fit for everybody. But luckily, at the moment, we are at the early adoption stage where people and institutional investors in particular, they're just allocating a very small part of the portfolio, 1, 2, or maximum 5%. So they are less sensitive to any downside volatility in particular. So I believe this will be a longer term topic when institutional investors, they start to allocate not anymore 1 or 2%, but 5, 10, or 15% of their portfolio into crypto. And that's where I think also volatility hopefully will come down a bit for certain assets like Bitcoin, because otherwise they couldn't manage to scale to such a large exposures. But there are a number of ways you can manage volatility. The option market is growing a lot. So I see definitely, let's say, outside of crypto, I would say, or outside of the blockchain technology itself, I think option will be a very hot topic next year in crypto. So institutional investors, to enter this space, they need a more mature option market, and they need to be able to manage the volatility of the market. So I hope that there will be more products that help you kind of get an exposure to crypto, and scale your investment without kind of losing attractiveness for new entrants. Because if we create products and attract players in the market that are just okay with 70-80% annual volatility, this will remain a niche market of 5-10% of the population, because we're not going to change the risk aversion of the world, of the people in the world. We need to kind of give them different ways to enter the market. And ETPs, they try to tackle this issue. So they try to attract people that are not tech or crypto natives in the market. But we need perhaps also stable coins or USD or Euro yield products that attract people that are also not going to accept the volatility of Bitcoin and Ethereum, and or create portfolios that minimize volatility that can be investable by different kind of investors. So if you want to bring on board your mother or your grandmother, you need to create a less volatile portfolio probably. Otherwise, irrespective of the return profile, they might never invest in crypto.
Yeah, definitely. And I guess, you mentioned there, it's like these, these having these different products. So I guess, we've seen in the US with futures where a lot of these institutions, they don't actually want to hold Bitcoin, but they want, or crypto, they want exposure to it. So futures and options sort of provides them that exposure without actually sort of holding it. They might hold that at, the product rather than the actual crypto.
Like the biggest opportunity is in the fact that on USD and Euro, with a cash and carry trade, that is kind of traditional trade in the market, you can generate 6 to 10% interest rate per year. And in a market that is struggling for yield, now the bond market sees very terrible say risk-reward profile. Crypto is a huge opportunity, so people should look at stable coins. They should look at the opportunity of extracting yield from crypto with cash and carry, with covered call strategies. There's plenty of traditional strategies that can provide a very attractive fixed income products in crypto. So I believe the crypto fixed income market will grow a lot next year, and then it will attract a different kind of investors, not people that perhaps they don't like crypto, they're not believing in the long-term value of crypto, but they need they want opportunistically to take advantage of the yield that crypto enables.
Yeah, it's interesting. So we go on to our next question with you, Raj, again. So in your opinion, what indicators suggest that a crypto bull run is coming to an end? Is there anything you watch?
So I'm not suggesting that at the moment the crypto bull run is coming to an end, but I'm saying there are indicators that can tell you that when the crypto bull run is coming to an end. I'm suggesting just that there is a good chance that next year let's say the market might calm down and there might be a rotation of the portfolio into other things. So people might look less at art NFTs, or they might look more at stable coins, for instance. But definitely, like I don't see a parallel, to be honest, between December 2017 and right now. So I don't see the same overvalueness, and I think there are on-chain indicators that are interesting, that can give you a sign of exhaustion in the market, not seeing new flows. But there are also indicators now coming from options and derivatives market, because these were not really present in 2017 and 2018. Right now, there's a lot more volume in the derivatives market, but in particular also on the option side. And the option can give you some signals, in particular the divergence between the volatility of the assets and the implied volatility, or the volatility of the volatility. There is a number of indicators that I believe they work also in traditional market, even technical indicators such as RSI, that give you a sign of exhaustion of a bull run. And I don't think that there's an easy receipt in crypto, as there's not an easy receipt in any market, and it's hard to tell when the market will correct. I don't see this exhaustion right now, but at the same time, where the Bitcoin appreciated around 4x this year, so I think it's fair to assume that if it does appreciate another 2 or 3x, we should not expect another 10x appreciation in a straight, which it can happen, of course, if the entire currency market collapses next year. But I'm not forecasting the currency market to collapse next year. I don't forecast the USD to collapse next year. I will actually bet the USD will do quite well next year if I need to bet on something. Yeah.
That's interesting, especially with the Jay Powell mentioned yesterday that he thinks inflation will be a bit more long term. But
exactly.
which would be interesting.
But also inflation, when it went from being let's say an episode to a systematic inflation, it didn't do well to risky assets like equities, real estate, and so until it's transitory, or people think it's transitory, inflation is driving assets to store of values or commodities, crypto. Crypto definitely attracted more than commodities this year. But when people realize that central banks cannot correct inflation, I think the markets start being a little bit more risk sensitive. So a risk on asset like Bitcoin, I'm not sure is the go-to asset when people realize inflation is out of control. So I think the consideration of that you just mentioned, it can be seen double side. So until now, everyone is saying it's transitory, but if it goes up more than it's going up right now, I think it will be a big red flag for a lot of hedge fund managers and macro managers, because it means it's out of control, and then the central banks are out of weapons to control the inflation, which is a new environment, and a new environment means new risk. So I do hope that inflation will be stable in certain respect, but I do agree that inflation has been here to stay for the long run, personally. So over the long run, that of course it's an amazing news for crypto. But again, when inflation goes out of control, it shifts to a risk-off environment, in my opinion.
Yeah, and as you said there is still correlation. Like, during COVID, that's when we saw the $4,000 low. So I guess there's, as you said, when these massive macro events happen, there is still that risk off, and people are just trying to get into cash or fixed income.
No, I think definitely, like COVID, every COVID wave has been associated with an equity correction, and you could see some correlation also with crypto correction in the similar period. So I think hopefully next year we'll have good news with COVID and we'll get out of this. But doesn't necessarily mean this will be a great news for the equity market, because actually the equity market did quite well in COVID times. So from an equity investor perspective, I'm not hoping that COVID disappear next month, because they kind of forced the central banks to step in and provide huge liquidity. So when this liquidity will be unfolded, that might not be such a good news for the equity market and for crypto as well.
Yeah, definitely. So we have another question from Harry. So he says, do you have an opinion on DeFi 2.0 narrative and at the moment? So he gave an example of the Olympus DAO and having protocol owned liquidity within decentralized finance space.
Yeah, I must be honest. I read something about Olympus DAO, but I don't know enough. So let's say I don't understand what is the change from DeFi 1.0 to DeFi 2.0. These are venture capital narratives that they raise a new fund and they want to say, well, first fund was on the first generation, the second fund was the second generation. Just speaking poorly about venture capitalists, but I'm not sure there is a fraction between an innovation like such clear. But definitely, I guess liquidity mining and liquidity pools, they are a big topic. Again, I think traditional players, they cannot just implement a liquidity pool. So this will be more difficultly adopted by traditional financial players. But there is a disruptive technology. That being said, kind of liquidity mining as a principal risk that is very clear, and it's usually resulting on loss of capital when you provide part of your capital to a liquidity pool. A lot of the protocols this year, they offset this capital erosion by distributing tokens like Uniswap and so on and so forth. But I'm saying either this token will continue to have a huge inflation, and then probably they will be facing a huge downward pressure as soon as the market kind of calms down. I'm not speaking about even a bear market, but normal flat market. If you have an inflation of 20-30%, those assets did quite poorly historically in crypto, that we assets with a very high inflation. Or if the inflation goes into reasonable territory, then my question is how these liquidity pools and liquidity mining are sustainable over the long run. Let's just make sure there's not such an hidden risk in these returns over the long run. So I believe at a certain point, I don't know when, otherwise I would trade that. At a certain point, we will see liquidity kind of dragging out, and a few smart allocators will be providing liquidity to this market, because my parallel is on the market making markets. This market is open to everybody. It's not open to few selected market makers, but probably the people that will monetize this opportunity are few selected market makers, because this liquidity pool is fitting the expertise and the risk profile of market makers. So I guess that's not something we see right now, but over the long run, probably few players will emerge that are able to profit of this opportunity, and most of the liquidity, especially the retail liquidity, will dry out.
Yeah, it's interesting. And I've seen something as well where, because, you lock up your capital in these liquidity pools, but there's also other DAOs where you have to put, lock up your capital into these DAOs through smart contracts. So do you see there being an issue in the future where there's so much money in these DAOs and in these that it could actually provide liquidity issues for like Ethereum? Because I think there's 20 or 30 billion dollars of Ethereum like locked up in these DAOs and certain smart contracts. I don't know if you see that as a risk or if I'm misunderstanding it.
I think already in 2018 we've seen that an asset like Ethereum, that is the main collateral for the DeFi space and is the main collateral for secured loans, is an asset that is more prone to steeper correction versus Bitcoin, for instance, because we've seen a number of protocols like MakerDAO and other that liquidated a large part of Ethereum on exchanges, on Bitstamp or whatever, in instant manner, with not looking at best execution or not using kind of Wall Street best practices, and that kind of pushed down certain assets very heavily. Like personally, I think Ethereum has incredible potential now. It attracted capital from institutional investors that they saw Ethereum not just from the industrial use case standpoint, but also as a store of value and a competitive store of value with Bitcoin. But definitely, it's an asset that is quite fragile to scale the liquidation. So I think it's an easy bet to say that if Bitcoin corrects X, Ethereum, in the case of high volatility and dramatic downside volatility, will correct X plus Y. So I think it might even be more sizable correction. The delta might be even more sizable this time because there's more assets locked on DeFi, and I'm not sure people thought about this pessimistic scenarios and thought about how to limit the impact on the asset. At the same time, there is the opportunity of rolling out it 2.0 next year. So there's also an opportunity for Ethereum to attract even more capital if they're successful in transitioning from proof of work to proof of stake. So it's a very interesting asset, and definitely Ethereum next year. It will be a very interesting year for Ethereum. So that probably will be a hot topic, Ethereum next year as well, for ETH 2.0, but also for what you discussed. Yeah.
Yeah, it's almost make or break. Same with ADA as well, to do with their sort of smart contracts. But we have a few more questions and then we'll wrap it up. So Yuvraj has asked another one about the actual Iconic Holdings token. So I'm not sure if you know much about that, or sort of what is the utility of the Iconic Holdings token?
Yes, so let's say we launched in 2018, and we got an actual letter from BaFin. So we kind of try to make it as compliant as possible in this uncertain regulatory environment. And we launched with the idea of giving access to our deal flow, to the token holders, and not only to our deal flow, but also to our diligence and expertise on blockchain investments, being that equity of blockchain companies or ICOs. As we saw basically that there was a lot of capital coming from retail in the ICO market, but those investors, they were not really familiar with what diligence means. So we try to use this token as a gym membership, if you want to call it, or as a membership access token to get access to our pool of deals and expertise and diligence. More recently, let's say we combine that with our pivot towards the asset management side. So we use our token, and we actually buy back our token with the proceeds of management fees of our funds and other products that we manage. So we have kind of two level of utility, one kind of related to the success of our asset management side, and trying to incentivize also our investor into investing into this kind of token. And the second was more related to the accelerator business in giving access to invest to ICOs, token investment, and blockchain company investments.
Yeah, it's really interesting. So we have another question from Yusuf. So he's asking, do you think there are too many coins that offer the same utility at the moment? And as the market matures, do you think only the best will survive?
I think there's definitely too many tokens, but that's not a bad news. It means there's a lot of innovation, and so I definitely think that as the market will mature, as we've seen right now, just 5% of them will succeed, and 5 is too super optimistic. So I guess it's the same we've seen since 2017. Like, there was thousands of tokens, and most of them in the last 3 years failed, and we will see a similar ratio in the next 3 to 5 years. But that's good news, because there's a lot of trash in the market for sure. So if some projects fails, it's not necessarily bad. And I believe also when most of these tokens were launched in 2017, 2018, tokenomics was a new topic, so people knew very little. So now perhaps even token issuers are becoming a little bit smarter, and they issue a token just when they have a consolidated business, they're an advanced product with a user base, and they're more sensitive to the tokenomics design. So they're not allocating 50% to the founders anymore. But there's a bit of everything in the space. So you still have pump and dumps, and then tokens that have no value, but they still appreciate. So definitely on that, there is a lot of opportunity to mature in the next year for the space.
Yeah, Jeff, that's interesting. We've just had one last question coming in from George, nice and late. So do you consider riding hype on coins like Doge and SHIBU and other similar coins? Do you ever just, FOMO in early and then get out at the top, or?
No, I don't want to underestimate this trend, because they are symptom of a new generation that is seeing money differently, and they decided that a meme is their favorite money. So at the same time, also, I don't want to put on the same level an asset like Dogecoin that has been around since more than 5 years, even though few players have high supply of Dogecoin. Dogecoin is a chain that has been around since more than 7 years. So they have a track record, that allows, I believe, even professional institutional investors to invest in them, because I believe one of the biggest reasons for the success of Bitcoin is that the oldest chain is one of the largest, but it's also the oldest, so the long-term track record. And that's is an advantage that in the meme category, Dogecoin is sharing, that they've been around since very long. They've had sustained volume very long, and right now, like Dogecoin has real activity, real trading volume, more than Cardano, for instance, and other assets. So I believe people, and especially institutional investors, should pay more attention to that, because it's the symbol of a new generation of investors that now they're 20 or 30, but next year they will have a lot more money. So I definitely think there will be more meme coins and more meme coins that will succeed. I personally miss that trend of Dogecoin and of Shiba. But I guess this should really be a topic to be investigated, and people should consider supporting Dogecoin, even institutional investor. I do think that it's an asset that is not here to disappear overnight, and so I guess there will be ETPs and funds on Dogecoin sooner or later. And I see no reason why there should not be. There is real trading activity, and there's a lot of demand, in particularly from retail investors for assets like Dogecoin. It's part of our index, and for me, it's an asset that I would put on the priority list to securitize or to structure a product around that, because I don't think there will be 5 Ethereum contenders that will succeed. There's perhaps higher chance that in the top 10 there will always be a meme stock such as Dogecoin. So while I don't think Solana, Cardano, Avalanche, and they can all succeed at the same time, as they're kind of overlapping, Dogecoin is serving a different need, and it's unique in certain respect. So I guess a lot of traditional financial players underestimate the potential of being relevant for other 5-10 years for an asset like Dogecoin, or it could be Shiba. I am not an expert of meme coins, to be honest, unfortunately. Otherwise, I've already retired probably.
Exactly, on a nice beach somewhere. So Ivan, thank you so much for joining us today and talking it through us. So just on to my last question. If there's one thing that someone could take away from our talk, what would it be? What do you think they should take away?
Let's say crypto is one of the biggest, and it has been probably the biggest opportunity ever come in the financial industry. But there is risk. So I think now everyone been talking this year about the opportunity. Perhaps a good takeaway is that the next year, perhaps people should think about the risk and how to manage risk if they want to succeed in this space. So I hope that people will, now that they have understood the opportunity, they will understand also how to manage the risk next year.
Perfect. I think that's a great piece of advice. So if anyone wanted to get in contact with you or maybe look at Iconic, what would be the best ways of doing that?
I'm on LinkedIn. So I think on LinkedIn, it's easy to reach out to me, or you have my contact details. Perhaps they can reach out to you and you can pass my contact details. So as you prefer. So.
Yeah, cool. That's all good. I'll share that if anyone wants it. I've also put the YouTube link in the description in the chat where we'll be posting the interview in a few days. But Ivan, thank you so much for joining us today and speaking to us, and you gave us a little bit more time as well. So thank you for that.
Thank you very much, Anthony, and good luck with everything. And it was a pleasure.
Thank you. You too. All the best. Good luck with the investments. Hopefully you can retire soon.
Let's cross fingers.
Yeah, exactly. All right. Thanks, everyone.
Pleasure.
See you later. Bye. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.